Thank you everyone for the patience. We had a little bit of technical glitches, but Matt Turck is here from FirstMark, and we're super excited to kick off our monthly fundraising workshop. Quick intro about SVB. We've been the bank of choice for the innovation economy for over 40 years now. Now we're part of First Citizens Bank, so we have the backing of their $200 billion fortress balance sheet and a robust loan book to continue recommitting and serving the innovation economy. We sit between founders and VCs. So what we really love to do, especially within the early stage startup banking practice, is helping founders beyond banking. So what that means, I lead our founder success team. We help founders with the fundraising process, with the company building advisory, and then most importantly, the larger connectivity to the SVB and New York ecosystem, because we know surrounding yourself with the right folks is what supercharges your company to the next level. I want to introduce Ariane here, who's also part of our VCRM team. So let us know if you have anything else to add.
Hello, and it's great to see such a great group here in the room. It's great to have you, Matt. Thank you for doing this. You have a double header today with Data Driven tonight, so thank you for doing this. I work with our investor coverage team, so I think of us as connectors of people and dots. So if you ever want to brainstorm on what kind of investor profile might make sense for your company, happy to do that. As just part of how we are so happy to still be here. Obviously, you're in our offices, and the past several months have been kind of dramatic in regional banking.
Yep.
But we're just so happy to have you all here and be back to doing what we love, which is supporting founders and investors in this wonderful system.
Great. Awesome. So let's get started then. My laptop will proceed. Great. So quick intro about myself. My name's Bo Wren. I'm the director of startup banking. I lead our New York early stage practice. So we help support pre-Series A companies with company building, banking needs, as well as investor connectivity. My operating background goes back about 10 plus years. So I actually started out as a product manager, made my way into corporate venture at Samsung and started incubating companies at New Lab, and found my way here at SVB. Super passionate about supporting early stage companies, especially folks who are product driven. I'm going to turn it over to Liz Cahill, who will be joining us as a co-panelist.
Thanks, Bo. Hi, everyone. I'm Liz Cahill. I've been with SVB for 6 years. Echo. I've been with SVB for 6 years. I'm based in San Francisco, and I study private markets and with a focus on early stage companies. So I'm going to hopefully help break down some of the things that are going on right now in the macro environment, and also how that applies to fundraising and early stage startups. So it's great to be back on the fundraising workshop.
Okay. How about now? Yes. And then mute. Can you guys hear us? Okay, great. All right, so let's intro Matt. We're joined today by Matt Turck, who's managing director of FirstMark. He's been with the firm for over 10 years. He specializes in investing in early stage software and cloud companies with a focus in data infrastructure, ML, and cloud. Matt publishes what many of you read, which is the annual MAD industry landscape, and that covers ML, AI, data. He also runs, which I think is the coolest part, one of the largest AI data groups in the country, called Data Driven NYC. So definitely join that group if you get a chance. I know you also have an evening event with the Data Driven group as well. So without further ado, let's get started. So why are we
still not sure about that hair? It was just like one day. I'm like this. For the last 10 years, I've had that picture. Like I never changed it.
You truly peaked in that moment.
Yes.
Yeah. No, very, very suave. I love the Brooklyn brownstone background.
Yeah.
Peak New York.
It was pre-generative AI.
Pre-generative AI, exactly. AI's taken a lot out of you. So why are we here today? So we're gonna cover three main questions around fundraising. It's, as you guys know, fundraising is not a one-size-fits-all solution. It's a fairly bespoke process. So we're gonna talk about how you can uniquely position yourself in this very weird market right now. So we'll be answering, three main questions around why you, the founding team, why now in terms of market timing, and also why the problem space in terms of the sector and industry you're going into. I do have to caveat that the data we're sharing here is very heavily indexed in New York. So there's going to be some variance depending on geo as well as the stage of company that you'll be fundraising. We'll be covering, mostly data from 2020 to 2023 here. Cool. So I'm going to turn it over to Liz, who's going to give our state of the market update to kind of set a foundation for the macroeconomic landscape.
Awesome. Thank you, Bo. It's so great to be here. I'm going to be in the next few slides sharing some market data, and Bo and Matt, feel free to jump in. And if you have questions, folks on the line, feel free to put them in the chat. So right now we're sort of in this mixed sort of angsty period for markets right now. We are finally seeing record inflation retreat, and new numbers just came out today, and we are starting to show further declines. So that record inflation that we saw during 2021 into 2022, that was created largely by, record quantitative easing. So the Fed basically, put a ton of money into the economy. We had PPP, we had other government programs during the pandemic that were larger than any other stimulus we had previously seen. Even the stimulus we saw after the great financial crisis, the bailout, this was bigger. We coupled that with some supply chain shocks and geopolitical uncertainty, war in Ukraine, and this was just a recipe for runaway inflation. So the Fed, is part of their mandate to keep inflation low and also to keep employment high. And that's their dual mandate. And we've had relatively good unemployment numbers. So the Fed has aggressively raised interest rates, and we're in a period of faster interest rate growth than any period of history. So we've just seen interest rates raise precipitously over the past year. And that's, basically put the brakes on markets. That's the intent of increasing interest rates. The Fed wants to slow things down, cool things off. And we've seen, that dip in inflation can be partly attributed to the Fed's work. We've also seen the supply chain pressure ease. I've pulled the Global Supply Chain Pressure Index, which is put out by the New York Federal Reserve Bank. So your local Fed, to some of you in the room, support your local Federal Reserve Bank. And they have this great index that's basically the standard deviation from a historical median, looking at supply chain pressure. So we saw that really bump up in 2020 into 2022, but this year, supply chain pressure has really eased, which is fantastic. So we've started to see some of those forces that would cause, more inflation to cool. And then public markets have been choppy. 2022 was one of the worst years for returns ever. We had, stocks were down, but also bonds have been down as well because interest rates rose so quickly. A lot of bonds are also underwater. So it's been both, stocks have been down and also bonds have been down. Markets have improved a bit this year. So things are starting to open up again, but it's been a choppy past, 12 months or so. And then private investments, so VC investment in US tech has declined since 2021. That was a peak. And we saw less investment last year, about $247 billion. And this year we're at about $75 billion. So, do the math, we're going to come out lower than 2022, probably. However, we do have record dry powder, which in the next few slides, I'm going to show you that dry powder though it exists, funds are investing at a much slower pace. So it's capital that they have committed, and it's, on paper, it's there for them to invest, but they are definitely being a lot more thoughtful and AKA slower, last year and into this year. So this is just to set the stage of where we're at. This is, some of the broader scaffolding, so to speak, for the economy right now. And from there, that, essentially then applies to companies, trying to raise funds. These are the big forces, up above us. And then that, trickles down into our day to day and impacts how we fundraise. So if we pop to the next slide.
Actually, I wanted to pose a quick question to Matt, in terms of how you advise founders thinking about dry powder. That's a common question we get, is like, even though a fund may have just closed, their most recent fund, how do they really think about just like making sure that they're going to get an allotment of that dry powder, especially in such a volatile market right now?
Yeah, so it's a great question and a pretty confusing thing. So like, again, to summarize what to play back what they just said, like on the one hand, you have funds that have raised more money than ever in the last couple of years. So they're just sitting on a lot of money. Yet, as you can see, that money is not being invested. So the general thinking is that, okay, well, maybe now is a bad time, but like at some point, surely funds are going to start deploying at a crazy pace, and everything is going to go back to normal. Normal being sort of like 2021. But in reality, what's happening is that we're all going back to the actual normal, which was more like 2015, 2016, when deployment was, vigorous, but much slower than it was in 2021. So for me, the right way to think about dry powder is not total amount of dry powder, but dry powder available per year. So what happened in 2021 is that people would raise, let's say, $1 billion, and they would, people being VCs, and they would tell their LPs, our deployment cycle is 3 years, but in reality, they would just like deploy in a year. So just like invest, and then go back to LPs much faster than anticipated, which by the way, pissed off LPs, rightly so. But now we're going back to, okay, instead of like deploying the whole fund in a year, we're going back to what that was supposed to be, which is to deploy in 3 years. And in reality, my sense is that when we look back, I don't know, we'll see, maybe we'll end up deploying, 4 years, 5 years instead of 3. So it's not the total amount, but the total amount available per year.
Yeah, that's really key distinction. All right.
And then looking at overall VC fundraising for companies in the US, like Matt said, we're seeing maybe a return to 2020, 2019, that era. 2021 was an anomalously large year for VC investing. We were coming off the pandemic stimulus. We had, a lot of interest in tech. There was a lot of money that needed to go somewhere, and US markets are just seen globally, public or private, as a place of stability. So just there was a lot of, capital flowing through US public markets, but also US private markets. So 2021 was this massive year. 2022, people were complaining, oh my goodness, we're not seeing as much activity. But, if you look at what we were coming off, it was just a year that surpassed all other years. I have a chart later in this presentation that goes all the way back to 1999. So we'll really see the run up. But this year, like Matt said, we're probably returning to, we're going to be perhaps under $200 billion in fundraising. And that's, taking us though back to 2020, 2019. And it's a drop, but it's more in line with prior years. And then we have still seen some very large deals in 2023. There is activity that is still happening. Of course, we've seen OpenAI raise an eye-popping $10 billion, mostly from Microsoft. We've also seen, Stripe. We've seen, Generate. We've seen some other folks on here. Anthropic raised $100 million Series A a few years ago, and they've continued to be on a tear. So there are large deals happening. It's just, it has to be the right company. On the next slide, I have this data sliced by New York VC investment, and we've also seen some large deals in New York this year so far. So again, fundraising is still happening. We have niches like, generative AI that are huge. Also climate tech, you see block power on there. There's spaces that really are generating a lot of interest. So, fundraising is down, but it's also, if your company is generating interest, if you're in a space that's poised for growth, there's still money out there. Then if we hop to the next slide, let's see. So yes, dry powder. When you were chatting about dry powder earlier, I was like, wait, there's a whole slide on dry powder. So you can see, we've had over the past few years, funds, so venture funds have fundraised. And that's the thing, like people don't realize if you're a founder, you don't realize that, VCs are funding you, but they themselves also have to fundraise. And they're going out and approaching limited partners to invest in their fund and saying, hey, we can be your gateway to private tech investment. We have a great thesis. We have a great network. We've had a great track record. So investors are also selling themselves to prospective, investors to say, hey, come on in, join, commit to our fund. So when we talk about dry powder, we are not talking about, cash in a fund's bank account. It is capital committed. So it's on paper. It's a promise that, when the fund is ready to make an investment, they can call up their limited partners and say, hey, remember me? We chatted a few months ago and you committed to my fund and now we're ready to make an investment. So investors will call up their limited partners. It's called a capital call. And that money will get pulled in to then be sent to the portfolio company the investor wants to invest in. So in 2021, we saw a lot of deals that, happened very quickly with very little diligence. Companies that weren't looking to raise funds, had investors knocking on their doors because everyone just really wanted to deploy capital. It was a super heady time. Everyone wanted to get in. Everybody wanted to invest in as many deals as possible. Deals were very competitive. You had a lot of PE growth firms, non-traditional investors, the Tiger Globals of the world coming in very aggressively to get in. But now we've definitely seen that cool. There's just been, you have some cases where, investors have gotten very burned. The most extreme example recently is probably like the FTX, moment. That was, a lot of, Sequoia lost a ton of money on that and had to write that down. So they have to go to their LPs. Investors have to say, okay, we made a bad decision. We had to write this investment down. And now investors are being a lot more careful and doing a lot more diligence, because if they're going to go to their LPs and call that capital, LPs are feeling a bit burned from some of the things that have happened, when things were looser. So investors want to show that, like, hey, we're being really thoughtful. We are taking our time to do our diligence. We're waiting to see where prices are going to land. Things are being repriced right now. We'll talk about it in a later slide. We're seeing down rounds. We're seeing valuations cool down. So investors are kind of waiting to see where prices are going to settle. And then I love this graphic here on the right. This is from Carta, showing that those capital calls are in decline, over the past year, looking at January 2022 to May 2023, for funds, we're seeing a 45% decline. For special purpose vehicles, it's even greater of a decline. So maybe Matt and Bo want to opine here, but this is, this is sort of the landscape that we're in right now with funds.
I think this chart from Carta is so interesting because it's kind of to Matt's point, like there is record dry powder out there, but the VCs themselves have been slowing down their rate of deployment. And also they're really metering it out in terms of thinking about valuation and where the macroeconomics as well as LP sentiment is going. I'm curious, like Matt, like what do you think is the psychology of investors right now for our founders these days? Because it's confusing to be like, there's record money out there to be had, but it's not readily available.
Yeah, There's a variety of things at play. One of them is that it's actually unclear what a Series A or a Series B is in this current market. Look, ultimately, an investment is a deal. There is a bid, there is an ask, and right now there's too much spread between the bid and the ask to make this sound very confidential. Obviously venture capital is not just that transaction, but it's the years of relationship after the transaction, but the transaction does matter a lot because that's what ultimately returns for investors. And, it's sort of weird. As Liz was saying, the market has been choppy, it's very volatile. Everybody's trying to figure out what's going on. I guess maybe we'll talk about it, or maybe we have already. There's a generative AI world, which is like, it's probably like it's 99 or
We got some slides on
2021.
that.
Yes, and then the rest, some of which is really interesting, but again, what's a good Series A? Is it, we know it's not 20 on 100, which is, what you would find in the crazy times of 2021, but we don't know if it's back to 2015 and it's, 8 on 15. So everybody's trying to.
So what you mean, 8 million round for 15
On
million
15
valuation?
pre-money.
Pre-money valuation.
Making this up, but this is more like a 2015 kind of valuation. So the market hasn't completely settled down in terms of okay, what is the new normal? So I think that's a part of it. Another big part of it is that when you're a VC like me, so I'm focused mostly on the Series A stage, I do a bit of seed. But because I'm focused on the Series A stage, I'm a lead investor, and then I take a board seat. So I make big commitments to work with the company for like 5-10 years. So a lot of people think of my job as, I go around and just make new investments. But the reality is that it's a third. A third is new investments. The third is raising money from LPs, or managing the firm, whatever. And then a third is just working with my existing portfolio. And what's been happening in my world is that all of my companies at the same time have needed the help. 21, it didn't matter because whatever, there would be like another round of capital. So you didn't need to think about anything. And right now, for the last year, we've been talking about like RIFs and burn rate and sales efficiency and all the things, and that makes things very intense, which reduces the time I have to just look at new stuff. So it's all the things
Right. So it's not just capital allocation, but also prioritization of you supporting your portfolio now instead of
which is a big priority, right? Because when I invest, I look the entrepreneur in the eye and say, okay, well, I'm going to be with you, for supporting you through the ups and downs. So now is the time where it's a down. So now is the time to make good on the profit. So it's lots of different things, but it's been hard. Yeah. So it's
the nuances here matter.
It's not like we're scared and we run for the hills or whatever, because ultimately everybody knows that actually now is a really good time to start investing. It's always the same thing. Like the VC business, for all the glamorization of it, or maybe that's VC glamorizing. But for all of it, ultimately it's there's we got a finance job, right? It's buy low, sell high. And what we've been doing for the last few years is buy high and not always really sell. The big concern now is everybody has bought high and will sell low, which is
and there's less opportunities to sell too.
So everybody knows, sort of intuitively or thinking about it, that now is a great time to enter the market, because now you can buy low-ish, and the hope is that in 10 years you'll be able to sell high. So it's not like people don't know that, it's not like they don't want to, it's just a combination of the things. Okay, well, we need to deal with our existing portfolio, and then I don't know what it would do.
Sure. Super helpful.
All right, so hopping to the next slide, I think this is a great follow-on to what Matt was talking about. We are seeing, time between rounds increasing, taking longer to raise that next round. So, in 2020, things were moving a lot faster. Now companies, it might take, about 22 months to go from a seed to Series A. And, you have to be really mindful of your burn. The era of growth at all costs, where it's just like, hey, burn as fast as possible, grow as quickly as possible. The next round of funding is just coming down the pike. That has passed us. And it's a lot more of like, how can you manage your burn? How can you be thoughtful about, maybe perhaps bringing in revenue and to extend that runway. So we're seeing, across the board, we're seeing this tick up the time between rounds. So if we hop to the next slide.
And one thing to add here is like, it's not uncommon for you as a founder to close a round and then start thinking about your next round. Like it used to be 6 to 12 months in between rounds. Now budget, 12 to 18 to even 24 months. So just, always be fundraising. That's the motto these days.
To that point, with these longer fundraising rounds, we've been seeing a lot of insider rounds. Do you want to comment at all on that, Matt? The concept of, maybe it's not from Series A to Series B a formal priced round, but there's some more capital coming in. Do you want to share what you've been doing in your portfolio?
So to say inside rounds has meant lots of different things. So like historically, it was more like a sign of weakness. It was like a bridge because you didn't have metrics to go raise the next round. And then, in 2021, it was a sign of strength. Like, okay, like the insiders actually want to buy up more because they know if they don't, then like somebody else will come in and buy more of the company. So, and I'd switch again, and we sort of like back to, okay, well, it's a tougher environment, and people need support. So therefore, for some of the companies, not all of the companies will come in and support because the company is starting to run out of cash. So there's more of that happening. Actually, I think it hasn't even really started. So that's a whole, but I don't know where the economy is going. That's a world where, like, I hope I'm wrong. But there's a world where this entire startup funding, difficulty we've been having is just starting. In particular, I think there's a whole wave of companies that raised in 2020, 21, and they raised 3 years of cash. It's great, but you know what? Now there's a year left.
Yeah.
10 months left, and
They have to grow into their
comes to market,
valuations
yes.
from 2022.
Exactly. And whenever it comes to markets, I don't know what happens.
Yeah.
And then if we pop to the next slide, again, this sort of shows, through data, like practically what founders should be thinking of. So we have the time between rounds increasing, and then we look at the cash runway. So if, it's 22 months between rounds, and if we look at, companies with $0 to $10 million in revenue, that median cash runway of being about 15 months, that's something, you're going to have to make some cuts. So this chart in the bottom right on my screen is a little bit complex, but it's showing, it's a triple axis graph, but it's basically showing that if you want to cut runway, if you cut runway sooner, or if you cut spend sooner, you can increase your runway more than if you had cut that same amount at a later time when you have less runway. So cut while you have runway and you will gain more time. So I think that's something really important to keep in mind as you look to how you're spending, how you're deploying your capital, and how long it's going to take you when you think that next round is on the horizon. So we're going to hop to the next slide. This is early stage funding for US seed and Series A and New York seed and Series A. Again, this year is going to be smaller than last year. This again is the world according to PitchBook. So, it's what PitchBook has out there, but we're going to see this year cooling off a bit more. If we hop to the next slide. Down rounds. All right. So, as Matt and Bo said, companies have to grow into that, 2021 valuation, and they may not be able to in this current market. And so we are starting to see down rounds. This data comes from Carta, which they hold cap tables for tens of thousands of startups. So this data is pretty credible. Before they started putting this out, you really couldn't find good information on down rounds. You know, nobody sends out a massive press release saying that we've raised a down round. You know, it's yeah, it's pretty hard to get this information. So it's really hard to pull it on PitchBook. It was pretty spotty. So Carta has put out with their own proprietary data, you know, what they're seeing on their platform, you know, and the percent of down rounds in a given quarter in Q1 2023 was about 19%, which is a huge spike. So, and again, this is within their client base, so it doesn't represent the entire market, but we are definitely seeing, you know, it's great, you know, anecdotally, we're hearing about down rounds. So it's really nice to see it in the data. I do want to add that, you know, if you do raising a down round, you know, of course, it doesn't necessarily feel great to raise a down round, but, you know, it's more than just that, you know, it does have implications for your entire cap table. If you're repricing all of your shares, this can be logistically pretty difficult. I can maybe send out there's a law firm that has a great article about this, but there's a lot of details that go into, you know, repricing all of your stock. If you do raise a down round, it can be very administratively difficult to do. So funds don't really like to do this. Investors don't necessarily want to do this. They don't want to write down their investments. So many companies are seeking like insider rounds, just follow-on rounds, looking to existing investors, or there's non-dilutive options to extend runway, such as taking on venture debt. But I'm going to pause here and let Bo and Matt and folks in the room opine on this. So I think this is a hot topic.
Curious about, like, when you're thinking about advising your own portfolio companies who may be facing down rounds, like, how do you help them think through that? Is this something that is a concession, or is this something that is like pragmatic of like survival is paramount to grow?
So I'm more in the latter camp of pragmatic. Having said that, all down rounds are not created equal. So there is a species of down rounds that are particularly painful, and those are the ones that are closer to what's known as a recap.
Can you define that?
Recap is one of those words that, you know, 10 years ago, everybody knew what a recap was. 10 years later, nobody knows. So a recap is basically you redraw the cap table. So it comes with something that's pretty nasty called a pay to play, which is like, I don't care if you're the largest shareholder, you've already put like $80 million into the company. Now I'm going to put 10 million, and whoever doesn't invest alongside with me on the cap table is going to get wiped out. That's pay to play, and then recap is sort of the reorganization of the table. So that's one extreme, and when that happens, it's very, very demotivating for everyone. That's one extreme. Then there is like another sort of variety that's can be part of it, but you know, mildly more applicable, which is down around to the structure. So structure is a legal term that means that whoever comes in and puts more money has some kind of protection. So, you know, if you sell the company for less than 100 million, I get 4x my money, but if you sell it for more than 100 million, then I get 2.5x. So making this up, that's structure. So recap, very bad, but you know, better than death. Structure, not that great. And then there is a flavor of recap, which is, you know, to some extent what I've seen so far, which is just, hey, we're gonna change the price, and you know, instead of having 100 million valuation, now you're gonna have $80 million valuation. And that, you know, to Liz's point, yes, there's some administrative stuff, and you need to think about options repricing and all the thing. But in the grand scheme of things, look, public stocks go up and down all the time. You know, private stocks don't. But a down round in some ways is a manifestation that actually, you know, if the rest of the economy goes down, maybe your valuation should go down as well. And which is not, you know, conceptually that absurd. I have experience in my portfolio of one down round, which actually is the best company I've invested in.
Yeah.
And it was very much a position of strength. So I'm an investor and a board member in this company called Cahill Group. which is the global leader in enterprise AI. So for global 2000 companies, if you want to deploy LLM, so if you want to deploy like, classic ML, use that platform. And, Tiger, who I think is a very smart investor, but, went a little bit of sort of overdrive. So Tiger led a round of 4.6 billion valuation in 21. And, that was pretty aggressive, but they wanted to win the deal. So that's where this ended up. And 6 months ago, maybe we did a down round. So we had another great investor called Wellington, who's a very well-known investor at the intersection between public and private markets. And they said, yeah, we're going to put 100 million in the company, but that's going to be at a 3.7 billion valuation. And we said yes. And you know what? Nothing happened. It was perfectly fine. Okay, now we have 100 million in the bank, great investor. And yeah, so there was no structure. There was like nothing, completely clean deal. And it's fun. It's fine. It's just so there is a whole flavor of down rounds where people, all of us, whether founders or VCs that are already invested in the company. Yes, it's not ideal, but to your question, pragmatically, perfectly fine.
And what are the mechanics of when you do a recap versus a restructure? Like there seems to be a spectrum of bad to worse, right?
Yeah. So the worst is what I like describe recap, where your FirstMark, you put in $20 million in the company, and then somebody else on the cap table is going to say, well, I want to switch the company. I want to do a bridge into the round. And if I'm going to put 10, but only at the condition that you FirstMark put like another 10. Mm-hmm. And if I don't do it, then like FirstMark out.
Okay.
That's pretty nasty.
Yeah. So
those completely disappeared because, in the very sort of like highly competitive but kind of clubby environment of venture in the last few years, like if you do that to me, then like I'm not going to give you access to my next deal, right?
Right.
Like, that kind of collegial environment. Mm-hmm. But as the market goes bad, then that practice is going to come back.
Okay. Are there any like onerous terms in term sheets that you recommend warning founders to look out for during a down market?
Yeah, so I haven't seen those, but like all the stuff from 10 to 15 years ago may come back. I heard some term sheets that some of that I personally haven't seen any of it. But like all the good old classics of this, participating preferred, there is multiple liquidation preference kind of. So participating means
yeah, that'd be great to define. Yeah.
So you guys understand preferred stock. So preferred stock is the kind of stock that investors get when they invest, which comes equipped with certain rights. And a key aspect of this is what's known as liquidation preference, which basically means that if I FirstMark invest 10 million in the company and the company gets sold for 10 million, I get all the money, to just make it terribly caricatural, but that's sort of what it is. And if the company gets sold for 11 million, then I still get my 10, and then the million gets distributed among other people. So it's liquidation preference. Participating liquidation preference, which again has largely disappeared but may come back, is this idea that I get my 10 million back, but then I get whatever percentage of the 1 million in the 11 and 7 scenario I'm entitled to based on my ownership percentage. So if I own 10% of the company, I get my 10 million, and then I get 10% of the 1 million that's left. So that's participating preferred. And then the truly nasty aspect of flavor is like multiple liquidation preference. And look, I was a founder, a long time ago, and I was on the receiving end of this. So this is very, like a personal thing. It was extremely painful. But back in the day, you would have 2x, 3x, 5x liquidation preferences, which basically means that like if I FirstMark VC invest 10 million, then the first 30 million go back to me. So which obviously raises the bar. When you have like that possibly fine if you have 10 million of investment, but if you have $100 million of investment with a 3x liquidation preference, it means that unless you sell the company for 300 million, you get nothing. That's standard. So again, like I haven't seen any of those. I've vaguely heard like that somewhere they were coming back, but that used to be the norm, like back in 2010 or whatever. I don't like it. Like even as a VC, like it's not the kind of partnership I want to have with founders because if not just because I'm a nice guy, but like because I don't think that's helpful to me, because if I work with the founder and the founder knows that unless she sells the company for $300 million, she does nothing, she's not going to be motivated. So that doesn't entirely work. But anyway, that's some examples of messy stuff that may review.
Thank you, Matt. That's fantastic context. And I dropped in the chat, I hope folks can see it, an article from Cooley that really breaks down some of the technical details of down rounds. So if people are curious, they can hop on and check that out. The next slide, let's see what we have next. Awesome. So this is deals at seed and valuation. Again, this is the world according to PitchBook. So this tends to have a very positive bias because these are the deals that they pick up, from press releases, stuff that's been reported. So PitchBook will tend to skew way more positive, so the numbers can be a bit higher. But this is what we're seeing, from PitchBook this year for seed and New York deal size and valuations. So Matt, Bo, and folks in the market, I'd be curious to see how this stacks up to what you're seeing on the ground, because this is what, from a high level, sitting here in San Francisco, looking at giant data sets, this is what I can pull in, but I'm curious to see what folks are actually, how this stacks up to what folks are actually experiencing.
Are there significant valuation cuts you've been seeing within enterprise at the seed and Series A?
Yeah. So it's very much a tale of two cities, I guess, tale of two markets, whatever the expression is. So yes, across the board, rent sizes are smaller, valuations are lower. Anything AI tends to be just, and there's a lot of what I see these days is AI. So that's a whole different thing, which I think is clearly a little bubble that's being built there. So it's kind of actually it's almost like schizophrenic experience during my day, because it's kind of half of my day kind of dealing with unwinding all the crazy stuff from 21. And then I look at new deals and it feels like we're just rebuilding exactly the same situation in generative AI that we are unwinding.
History's repeating itself.
Yeah. It's a whole separate thing. It's not like anybody's crazy. It's like everybody makes, as investors or founders, like everybody makes a decision that at a micro level makes sense. Like, oh, I really want to win this deal. I love this founder. It's a great company. Oh, it's another term sheet. Yeah, I'm going to beat that term sheet. So now I want to do the deal. So like everybody does is rational at their micro level. Thing is, like when you step out, like you end up creating a monster because everybody does the same thing, right? So like the system is sort of not working from that perspective.
Also, I just wanted to quickly add that, at the early stage, these companies you're much more sheltered from public markets. So late stage companies, they're being, comped to public market companies as, their next step. So when public markets are really choppy, late stage companies, bear the brunt of that. But earlier stage companies we've seen are a bit more sheltered from, some of the valuations being slashed in half. We're seeing the early stage a little bit more cushioned from some of the macro forces.
Oh yeah, the seed, it's been, at least from my vantage point, it's been pretty vibrant. Sort of seed investment being done quickly.
It's more like the B plus that have experience.
Yeah, so C and D is a disaster. Although we can talk about this, like maybe there's a little bit of a inflection happening. B has been slightly better than CD. A has been actually pretty slow in my experience. And then seed, yeah, and pre-seed, just same.
Well, it's a good time to be a pre-seed and seed.
Yeah, it's a great time to be early. So if we hop to the next slide, let's see what we have next. Awesome. So this is the slide I alluded to in the beginning. This is kind of the very, very, very long view. And, we looked at past downturns. So 2000, we have the tech, the tech bubble, the pets.com, we had the .com bust, so to speak. And then, we had the 2007, these are the peaks before the drops. So in 2008, we had the financial crisis. So looking at, from peak to the next, the next peak, peak to peak, looking at these scenarios, we sort of project, what VC funding will be in the next 3 years based on these two scenarios. So the percent changes year over year from, 2000, 2001, 2002, 2007, 2008 through 2009, what things will look like. And, if we're in neither of these scenarios right now, but it's just to show that, like, hey, during our past, largest downturns, in recent memory, what will things look like over the next 3 years? And if we're in a, great financial crisis scenario, things rebounded pretty quickly. Tech was quite resilient. Most of the growth we've seen in the economy post great financial crisis has really been driven by tech. Like, most of the S&P, like over 20% of the S&P is like for tech companies. It's mostly just the FANG companies that make up most of the S&P 500. So tech in terms of, market cap and growth. So tech, in the early 2000s, the industry was a lot less developed. We barely had, a public facing internet. You got your America Online CD at the grocery store checkout. We didn't have, smartphones. We didn't have social media in a traditional sense. You had forums online, but we don't have all these products that we have today. And tech was not, integrated into every single company at every level. Now, we're in a much different world. So I think there's still, though fundraising has been down, it doesn't mean that, it's not a great time to be in tech. It's not a time to be innovating. Right now, I think it's the only time I've been in the Bay Area for 7 years, and this is the only time I've seen unemployed software engineers hanging around and looking for new projects. So, you have a bunch of big tech layoffs that frees up a lot of talent. There's a lot of talent in the market. There's a lot of folks that are looking for their next move. A lot of people are getting together and starting the next wave of companies that are going to bring us back up again to great heights. So just wanted to give everyone a perspective on the long view. And if you can see, since 2012, 2013, we've really seen, in the earlier 2000s, VC fundraising things were pretty flat, things were pretty sleepy, but over the past decade or so, we've seen this massive, increase in the market. The market's matured. We have a lot more data. The funds have matured. There's more interest in this space. There's more folks all over the world looking to invest in private technology companies. So things have really developed.
Such a great chart. Just if nothing else, I remember in 2017, people were like, "Wow, it's crazy. This is just how can you even do a deal? Valuations are insane."
Yeah. I also remember that time too. It was like 2016, 2017, like, wow, we're at the top of the market.
Yeah. So when you look at 22, which, sort of looks like 2x 2017, I don't know, from here, or even like 23 in a projected .com scenario, it's still largely above. So, I don't know. It's a great chart. It's everything very relative, I guess. It's great perspective.
I think
It's important to have that perspective.
when we look at 2021, that was like the best year ever. So like, of course, you're going to be going down after that.
Yep.
And that's just like, in terms of the larger timeline of history, like zooming out does give you perspective of like, from the peak, you're going to start going down, but it's not at the point of like a 2008 either.
Yeah.
Right.
Yeah. I think it's good to focus on more sustainable, like I'm all about sustainable growth. That makes me look bearish by, Silicon Valley standards, but I just, want, money to be spent prudently and properly and be, when we're in 2021 and money is just splashing around everywhere, it's not necessarily well spent. So this reset is, helping people to focus and build sustainable businesses that can actually exist in the world and not just in this, startup bubble, so to speak. So next slide. Wanted to pull in some, the talk right now is everyone's talking about generative AI. Maybe you saw everyone change their profile pictures to much more fantastical, mythical, portraits. I was thinking, Bo, we got to get our AI headshots up there, of us as like warrior goddesses with like pink backgrounds. Everyone looks like they're at Burning Man. So, AI went mainstream. So I feel like, in 2020, end of 2020, OpenAI made GPT-3 public, and, there were some early adapters on there, but I feel like in the last year, people just went bananas. Like some of these tools have been out there for a while, or in just different formats, but things have become really accessible in the past few years. A lot of things are open source. A lot of, you can go and read the research papers from the folks that are building these models. You can go study this. It's very open. A lot of people are copying. A lot of people are, I should say, iterating on these tools and technologies. So, you have GPT-4 now that makes very realistic looking and sounding human text, whether it is not necessarily at all factually accurate, but there was a law firm that was actually busted for using, they used GPT-4 to do case research, and GPT-4 spit out some legal cases that didn't actually exist. So they were reprimanded for that. So just, be careful what you're asking GPT-4 to do for you. But, you have diffusion models that are generating images. You have the Midjourneys of the world, taking everyone by storm. I just saw an article about an AI, generated Beatles album that people are trying to put together. So it's, Pandora's box has been open, for better or for worse, on generative AI. And there's a lot of investor excitement in this space. So we're seeing in the broader markets, hey, fundraising is down, valuations are maybe being cut in certain places, but I pulled again some data from Carta. They pulled out some activity from their platform, and at the seed and Series A, we're seeing this, this bump for companies that are, in this space. But also, there's, AI is kind of a buzzword and has been for a while. So, but unpacking what that actually means and how companies are actually using it, I'd love to turn it over to Bo and Matt to we can unpack all of this, what's actually happening.
We're seeing true AI companies that are built on centralized AI versus a company that's just trying to tack on AI in their component in order to fundraise.
How long do we have?
We're running over, but we've got a good couple minutes.
I think all those things are true and exciting at the same time. I think I'm seeing a bunch of companies very quickly roll out AI using GPT-4 into their product, and that's great. I don't think that makes you an AI company, but I think AI is going to be deployed at scale and everything. So I think that's the beginning of that, and that's perfectly great. I do think if you want to build a true AI, sort of AI first native AI company, you need to build your own stuff. And you can still use obviously open source. You can certainly use some models from others, but you need to have your own machine learning AI team internally and focus on building something that could not exist if it were not with AI. But different flavors. I mean, I guess the easiest analogy is if you think of the mobile revolution. So yes, every single company created their own app, but still there were some companies that became huge, leveraging the very specific capabilities of the phone that would have not the companies would not have existed, have those capabilities not existed. So, obvious example being like DoorDash and Uber.
Well, I'm sorry, just can I ask a question on that?
Sure, yeah.
Maybe like a less cynical view, generative AI is pretty inspiring. So if we were working on something and we saw the potential for us to add value to us and to our users, but we don't want to position ourselves as a pivot, what is the non-cynical way to introduce the power of it in what we're doing without trying to pass ourselves off as an AI company, right? Like,
Yeah,
it's also just like a great thing,
right,
you know?
yeah.
So first of all, I think you should do it 100%, because ultimately all of this is about making consumers happy. So if you create a great feature that people love, like everything else follows downstream. And then second is the question of just presentation, marketing materials, or fundraising materials. Like every cycle, we see companies that 6 months ago were doing something like coming back to us, and now it's like AI on the cover slide. So you don't have to do that. So it's just a question of like, okay, how prominently do you feature it or not? But 100% do it. Like it's sort of amazing actually to see across my portfolio several companies doing this, and it sort of really works.
I have a quick follow-ups. We are mentioning in VC in general, AI is around infrastructure, kind of all the technological development around it, but sometimes the application layer is not left out or not thought about, which is primarily the user, the consumer, and not so much the business. Like, why do you think that people are not thinking about that consumer, about that user, about that, like, for instance, retail consumer, but more about infrastructure, about, the more business to business kind of interaction.
So why VCs not?
Yeah, VCs kind of the.
I think the general concern is that big tech companies have a little bit too much of an advantage for truly horizontal consumer stuff, which doesn't mean that for more vertical specific consumer applications there are not opportunities. Like anything that's sort of broad, like obvious example being search, and sort of hard I think to beat Google, Microsoft, because they've decided that it is what they want to do. Whereas B2B, the obvious difference is that every company has their own data set. So you need to have something that works with the company's data set. And therefore, there's an opportunity for people to be that last mile between whatever model and the company. So that, I think that's the thinking. But plenty of opportunity.
Okay, thank you.
That's one question here regarding the generative AI, and this is for you in particular, Matt. I mean, it's about differentiation, my question, as far as in the marketplace. I mean, we're dealing with something right now where generative AI, we're backed by the National Science Foundation, coming from Bloomberg and EY and Citi, et cetera. And we're going out there now, and VCs are looking at us like, well, they're hard. It's like they're trying to differentiate with all the decks that they're getting, right? And getting that. So from your perspective, I mean, you've been doing this for a while in AI. What is your tactics and what are you seeing among the VCs as far as differentiating between us?
Yeah, so from a VC perspective, there's certainly a little bit of the feeling of being overwhelmed.
Yeah.
At least, like for me, it's just like at some point everything starts just boring and sounding the same. It's just a massive volume of people, like specifically in that area, which happens to be my area, so I see some of it. So it's a longer conversation, but like for me, especially at the seed, I look at the. I'm mostly interested in true AI companies, and true AI companies typically come equipped with at least one of the founders being a truly deep AI and ML person. So that's one way and you can sort of that. So, unless you do lots of other things, to the earlier question, unless you do your just like a regular SaaS applications and you want to bring in AI, and then that's fine. That's a whole different thing. But like if the claim is that okay, we're truly an AI company, then I want to see on the team people like true AI specialists, because I don't think AI is commoditized. I think AI is still deep tech. I think to do something really interesting with AI, yes, you can use other people's models, but you need to get something that's appropriate. That's my.
And I think to your point, like the fact that you got NSF backing, like that in itself is a differentiator because like those SBIR grants are super rare to get. So like you do have something IP driven. So kudos, that's not easy. Right, so we do have a lot to cover, but in the interest of time, I'm gonna jump around. This is more like the tactical portion of our presentation of how do you raise your first round. So kind of key questions here would be like understanding the round in which you're raising, how you're gonna be using that, when is the best timing, how do you get your intro prep for the first meeting. So I want to stay on this slide as more of a textbook slide because we've had a lot of questions around the different life stages of rounds, and a lot of it has shifted in the past 5 years. What used to be pre-seed is now seed. What seed is Series A, but there are certain universal markers here. So like the pre-seed is going to be pre-product. That could be idea on a napkin sketch or having some type of prototype. You're not going to have a price round at that point. There's some dilution, but not a lot. And that could be, first round of friends and family. It could be a couple of angels, individuals. It's not going to be an institutional round. At the seed, the kind of marker for that is going to be more around the product is launched or you at least have an MVP. There's demand for it. There needs to be some traction, and I think this is like in the last year or two, like the criteria for a seed has increased where you do want to show real tangible traction, whether that be signups, design pilots, even some type of incremental like early stage forecasting around your revenue projections. That round is typically when you start introducing some institutional investors, so you could still have a healthy mix of angels, different seed institutions, as well as, at that point, this is kind of when you could potentially get it priced, depending on if you have a lead investor or not, and dilution is going to be going up. And then the Series A is kind of like the big adulting moment of like your product has some semblance of product market fit. Like they're in 2021 it was very frothy, so there were companies that weren't at that life stage of finding product market fit, but they still rated Series A. But now, since times are lean, that really does need to be the onus for you to show. You want to have early market signals. You're going to have an institutional Series A investor like Matt from FirstMark come in to lead the round, and it's going to be a price round. And around that life stage, you're going to be giving away board seats, and dilution is going to be increasing to the north of 20%. Anything to add here, Matt, on the different life stage characteristics?
I think that's great.
Can I ask one question on that? To what extent are you still seeing at the seed stage of 3 to 6 million actual notes like SAFE, for example?
You see some.
I'm also seeing a lot of smaller ones too.
Smaller, yes.
Two-
I mean,
two-
you get
2.5.
5 million, I assume you're
Yeah.
seeing more price rounds?
Yeah.
Yeah.
Okay.
But either one is fine. Like the only thought on notes is to avoid stacking them. So like when you have like 2 or 3 nodes.
Oh, yeah.
there's some weird effect.
Yes.
I had a
you
quick
had
question on round construction. As a Series A lead investor, how do you think about complementary co-investors? What's helpful in terms of leading signals, whether it's angels, alumni syndicates, or corporate VCs?
Yeah, we like them. We tend to have a more collaborative approach to doing rounds. We think it takes a village to build a company, and we've all experienced, and sometimes we'll have been like a small investor that just works harder for whatever reason, because they have that stage of their lives and will prove something, particularly passionate about the company. So we big fans of the people around the table. So, this is a whole operation of one company where the Series A and they reserved 2 million for value adding angels, but we got like 30 of them. And they have been very diligent and organized about, keeping those people informed, keeping them motivated, extracting value. So it's a whole project. I thought that was really smart. That worked well. Other than that, I like investor and small firm comes in. I don't like it as much when the firm that comes in is a multi-stage, firm that basically does this as an option creation.
As a quick follow-on, you've got more corporate VCs that say they'll lead rounds now. Is there any positive or negative signaling around that when it's a strategic versus not a traditional institutional investor?
Yeah, a lot less than used to be the case. So it used to be a real, kind of like orange, yellow to orange flag. But most corporate VCs now have become much closer to just regular VCs, meaning that they are investing for financial objectives. So that's less of a signal, but then, all things is a wide range.
I can also add to that. So having worked at Samsung Next, which was a CVC fund, you really have to think about the structure of the CVC fund. So if it's off a balance sheet, it's usually going to think about what is going to be strategic investments to the firm. So for Samsung Next, we thought about, is this potentially something that could be a partner for a certain business unit within Samsung Electronics? Could they have some type of distribution deal with the portfolio company? At another CVC fund, like a Bloomberg Data, for example, where they have a separate LP, that Bloomberg is the single LP, there is not as much of a tie back to the mothership. So I would think about the mandate of the corporate venture fund too, of what success looks like. Is it strategic or is it more for financial return?
Yeah. The ones that are known for having that very financial structure, this Bloomberg Data, this Dell Capital Ventures, this Google Ventures, now GV. Those are purely financial investors. And 12
And 12, yeah, for Microsoft, yeah.
Except now they're actually kind of getting rid of that financial structure and go back to more balance sheets and people like it. Question?
Yes.
Sorry, real quick. I think you both said that you go seed onwards, and pre-seed is on this slide though.
Yeah.
So just wanted to ask real quick if you really believe that in this market, the pre-seed size that's on the slide is still applicable, and if we combine it with the previous slide saying that the round sizes haven't really shrunk a lot in the seed pre-seed stage, do you think that slide is still up to date? Because
I would tell you that that's less than
Up
to 2.5 million, because most of
No, I mean, for me, it's also a lot about the fact that it's still pre-product. I'm not sure how many pre-product VC raises are really happening in this climate. I'm hearing from a lot of VCs that pre-seed even is down to 40% what it used to be a year ago. If you take AI out, it makes it more like 20% of what it used to be. And those 20% of companies will be the best 20%, which are maybe not pre-product.
yeah, no, look, I think that's fair. I think in general, it's less of everything, right? It's less series, less seeds, less, with the nuances I mentioned earlier. I do see a bunch of pre-seeds happening pre-product, but there tends to be something about the founders. That's, they're coming from famous company X or Y, or they have particular expertise in something. So it's, very much a founder bet, or they know the VC firm, they built a relationship, that tends to be something founder related.
Okay, I appreciate it. Thanks.
Yeah, or oftentimes there's EIR deals, you're an entrepreneur in residence at a fund. So you've been studying a certain space and you have a thesis on this is what needs to be built. So you get that early stage capital for the product.
Or you did YC, or you did Techstars.
Right. Yeah, but I mean, even YC is not necessarily a product anymore. Right.
Fair.
Yeah.
Out of 250 companies per class, it's a whole spectrum of.
Yeah.
But hopefully, by the time somebody graduates from YC, they have something.
Yeah, and there's something to call out here, which is like not all rounds are structured fairly. So like if you're a repeat founder, I've heard investors be like, oh, this is a blank check founder, right? Which is going to be a very different experience. Someone who's first time founder or someone who like has a certain white paper about certain piece of technology that is like deeply proprietary from an academic standpoint. So like there's exceptions to the rule, but I do think to your point, like that is a fair call out. Like the onus for pre-seed now is higher, where I would say like most people applied to would need some semblance of product or at least a POC.
What would be the minimum in terms of metrics? Not POC, you have the tech product. In terms of what are you looking for?
I mean, I think that really depends on like the sector, right? Like if it's enterprise, like at least have some type of demand from people to use.
Pre-seed,
For pre-seed,
pre-product, like this in discussion.
For pre-seed, I would only look at the founding team.
Not even product,
Not for me,
no, but
I don't
taking
think
into
I
account
do a lot of
that, taking into account that right now, the common thing is looking at not pre-product, but a product for pre-seed.
Look, the more you have, the better. So I don't, trying to think through pre-seed that I've seen, like I think on the whole they found that. But if you come up with something, it's better. If you come up, if you have like a product that's better than no product, if you have some user that's better than no user, and so on and so forth. But like at some point you start skipping the pre-seed and
yeah, I think that the spectrum between pre-seed and seed is like highly blurred. Like it's not even like a real like technicality at times, like here's the minimum, this is the maximum. It's usually like how much you want for that round, right? And if you want to bring in institutional investors.
so as I begin those conversations, I mean I completely get it, how it's just confusing as hell, this whole thing. Because it's ultimately those are like kind of deals where the investor and the founder meet and makes sense or doesn't make sense, right?
It's uncertain and you add more features to make it less uncertain.
That's for sure, for sure.
Great. So we're gonna fly through a couple of slides here. So I like to kind of cover the sales funnel here for thinking about vetting intros because I'm sure Matt, investing in enterprise companies, like the analogy of enterprise sales really applies here. Of like as you think about who you want to start reaching out to, think of it as like you have a long list of people that stack ranked by order of like least importance to importance, and you're working your way down that. So you have the practice rounds, you're talking to like the individuals, the mentors, the angels, the advisors who can give you feedback. And then as you get more of that like learning, you're gonna work your way, down to the more important VCs and like the lead investors. So I would really think of it as like a pipeline and like pouring as many people into that pipeline as possible, but like winnowing it down based off of like your strength of connection, refining your pitch, who will resonate with that, having different versions of your pitch depending on the investor, and really, hitting that fulcrum when you have one lead investor, and hopefully, that term sheet will bring on other investors.
So the word qualified is important. It's like exactly as you were saying, just as in any sales process, you want to sell to people that are likely to buy. So, not a complaint. I'm very privileged to be doing my job. Thanks. With that caveat, just like I wake up every morning and I've got like 10 people. Like so, I'm a enterprise, SaaS, machine learning, AI, data. It's like all over my my bio on the sites, all over my LinkedIn. It's everything everything I tweet about, and and I got like people that are pitching me some like biotech thing in Latin America, and partly it was like automated stuff, like they're just so I understand for them it's a numbers game, so there's probably like 500 people, but then
Might
like
be a
for a
bot
week,
generating.
like for a week every morning when they get like, Matt, still haven't heard back from you.
You're like, not my target.
And then the problem is like I'm so flooded with the things that like sometimes I don't even see the thing I'm interested in. So as you reach out, and every interaction, all the meetings, it needs to be highly personalized, right? Like first of all, because you don't want to waste your time, because, I'm not going to do the Latin America deal. And second, you want an investor on board that's going to understand what you're doing, has experience, can help, and everything. So just qualify, which is, it's not that hard. Just like go on the page, look at that specific investor. In every firm, there's typically like one investor that's really fit for you. Like we 5 investing partners. I'm the only person who invests in data infrastructure. My partner Rick, who invested in Discord, Airbnb, and Pinterest, is the consumer person. So consumer business, reach out to him.
Yeah, so speaking of qualifying, these are the different variables to consider. And to Matt's point, like there's a lot of public information online for you to think about. Life stage of the fund, location, are they sector agnostic, sector, Matt's clearly, in a deeply verticalized investor, size of check, like how big is the fund? Do they lead deals? The vintage of the fund is going to be a little bit more opaque because you don't always get the data around like how much of the dry powder is left, when was their last fundraise. Like PitchBook does have some of that data, but not all funds disclose it. So that's something to back channel and really poke around. And activities, just like, just because a fund invested in a competitor, what you're building doesn't mean they're going to take a look at you. And oftentimes, that's actually a negative signal where they don't want to be investing in more bets. If you think about the surface area of like VCs, they want to make multiple bets in different things instead of concentrated bets. Anything to add here?
For stage, just very practically, just go on Crunchbase, for example, and look up the fund, and that's going to list all the investments, and sometimes that's going to be something that says lead, and when you see lead, that's the stage they do. So if you see somebody doing like lead for Series C, it's more likely to be a growth investor or that stage. If you see something like FirstMark and you see whatever deal in like Series A lead, then Series A.
Great. And then just last couple slides here, landing the lead investor is kind of like the elusive chase of investing. Like that is kind of like the 80-20 rule of investing. Like once you get the lead, like everything kind of starts to come to you, but getting to that point takes a lot of momentum and activation energy. So, at the lead stage, you're gonna have an investor who's willing to put down a term sheet and set the valuation and price the round. There's also usually going to probably be a board seat that you give away, and that's more common at the Series A. The check size will be, larger, so they will have a dominant, size in the round, hence why they're a lead. And like these lead investors, they set the terms that other people either match or and you can take that term sheet and shop around. So this is kind of like the golden goose that you want to get to, but it's really the tipping point that makes the round close. Any tips here in terms of landing a lead like yourself? Any common mistakes and pitfalls you've seen?
I mean, nothing to add to what you just said. That would not be like a real conversation. Just show up in every one of those conversations, highly prepared, know exactly what the fund and the person does, tailor your pitch to that. And then we get into the whole like, what's a good presentation, what's a good pitch. I'm happy to look about that.
Yeah, I mean, we can kind of skip the angels part. I am very curious about like what you're thinking about of a good pitch deck and the presentation of what, whether that be like there's such range in which people are pitching now, from like, a tome like presentation to an investment memo. There's just like an explosion of media. So I'm curious, like what is a good format here?
In terms of format, I don't care that much. Like it's actually very nice as an investor to get to see different things, like different. So like not everything's a PowerPoint, but like PowerPoint is perfectly fine. Yeah. So in terms of like the format doesn't matter that much. You do want to cover like the usual stuff, like I don't like a slide on this or like this, the usual kind of like 12 slide format, which is going to cover, you know, what you do, the go-to-market, competitors, blah, blah, blah. It's like a standard thing. So you want to make sure that you cover all the bases. When it comes to are we going to talk about the pitch itself or the?
Yeah, the pitch too. Like, are you talking about like?
Okay, but
presenting
so the pitch in the room, if I had to boil it down to the essence, what the difference between a pitch are kind of compelling and most pitches is clarity of thought. And it's somebody that comes in, has a very precise idea of what it is that they want to do and how they're going to do it. And may work out, may not work out, but that's how they're thinking about it. And by the way, that thing is big and exciting. And I can ask whatever questions they thought about it. And they have very precise, compelling answers to the question. They've looked at the problem from the top, from the side, from the bottom. They're just, you know, I can try whatever. Big questions, small questions, they just know the answer. That's a great pitch. Which is why people that start companies where they solve a problem they're deeply familiar with because they experience it in their job. That's like the classic heuristic of venture capital. That's one of the reasons why that works so well.
So it's kind of like the depth of understanding in a problem space and having examined it from multiple angles, right?
Yes, exactly. And then like I started asking you a question about the pricing and like people like, well, you know, historically people in the space have done this and that, but like I'm thinking about this model. And those are the two hypotheses. So it's too early, I don't know, but this is like I would go this route. And if this and that was true, then I would keep it, but otherwise I would go that route.
Right, right.
Like that kind of like just delivery, you know, which by the way is something that you can hone in during a process where actually Toby from Shopify was telling the story of he would get questions during the pitch. And then he would feel mortified because he got nailed on a question and just I couldn't answer it, would go back to his car, spend like 2 hours working on that question to get ready for the pitch in the afternoon at that other firm. And you know, guess what? After you've done like 15 of those, then you're gonna ace every question.
Which is why the order of your list of investors you approach matters, because you want to kind of work with the ones where the mistakes can still be cheap in training for the ones that you want to like go talk to, like a FirstMark or Sequoia. So, yes.
And there's plenty of like, there's so many things, but don't bullshit. Like it's like this one thing that happens when you're an investor and you go through pitches, like they have to pay for years on end. You see right through whatever. Like you think you've been very clever, and like the investor like has seen this like 17 times, like you know. So like don't make up stuff. It's better to say I don't know. Let me get back to you. But then if you say let me get back to you, you better get back. You know, it's like first get back and second is a good answer. So I don't think.
Right. Yeah.
I have a question for you. So I'm a student here, and these pitches like we have done in group projects for our university, and we also always used to have time limit, like 6 minutes, 8 minutes, and all. So the question is like all the aspects which you are covering here, as you have listened to so many pitches, do you think there's a sweet spot of time and it should be within that range for like most of the investors, so they don't get bored and fed up, and also we cover all the aspects. Is there something like that?
Yeah. So the general, concise and to the point is great. So if you can keep it very tight, that's everything else equal, the better. Having said that, there's different situations where you do a pitch. Once you actually get in a room with a VC and you have an actual meeting, it's 45 minutes on the calendar. You do have the 45 minutes, so you should follow the guidance of the VC. But yeah, you do want to start pretty strong. And strong meaning like concise, like high information density, in the first few minutes.
And
It's a little
also,
bit of, again, like
there's an
this.
art to it too, is like if you're meeting someone at a coffee shop, right? You're probably not gonna break out your laptop and go through 20 slides. Like, so there is like an oral story, like to having more dynamic kind of just-in-time pitches. And then you're probably going to have the more formal pitches where like you send the pre-read and the VC may be like, I just want to jump to slide 20 and like go super deep into your go-to-market strategy. And you end up spending like 15 minutes just talking about that. So like there is kind of this like mental agility game you have to be willing to play of like calibrate to what your audience is looking for, and not every setting, every investor is going to want the same format. So I've worked with founders who have like 4 or 5 different decks too, depending on who they're talking to.
Just one thing, is it safe to assume like if we are pitching, keep it always on the shorter side because they are busy people and listening to so many pitches? It is to
Yeah.
maybe skip
Everything
some
else being important.
Yeah, absolutely.
And since we're on the deck best practice format, one thing I like is a substantial appendix. So you just have a pretty tight slides, 1 to 12 or whatever. But then you prepared for the question that comes up. Oh, it's like this, price again, pricing. It's like for this go-to-market, whatever. And you don't have necessarily have to share the appendix. That works well.
So in the interest of time, I'm going to jump to our last slide here.
I like the.
Do you want to cover that? Yeah, let's do that.
That's a really important thing. And again, like I was a founder for, a part of my professional life. So like I've been on the receiving end of a lot of no's. But by the way, VCs get a lot of no's. It's the weirdest job from the perspective. Because like sometimes you spend a lot of time saying no to people come to you, and sometimes it's a deal you really want to do, and like guess what? It's some of the 21st that want to do it, and then you get a no from the founder. So it's so I just contextually. But so much of the no's I give, actually not really no's as in, as in, I think you suck and your business is terrible. It's actually very rare. Like most of the times I go, well, it's not the right stage. It's not the, it's a question of qualification. It seems to be like sort of interesting, but that's just way too early, or that's not the right time, or you know what, like, in reality, what's happening is like I'm fundraising right now for our next fund, and I've already done a deal last week, and I'm not going to do another deal now, so I don't have the time. So it has nothing to do with you, but there's so much of that being behind the scenes, or I think it's like really, interesting, but I'm only going to do like 3 new deals this year, and this is just like right below it. So it's not like I think this is terrible, bad. It's just like. So
yeah, there's a lot of reasons why you gotta know, and like you can unpack it in different ways.
Yeah.
It's just oftentimes like you're also not going to get a straight answer out of it too. Like I think that's really rare, because you kind of have to think about the psychology of an investor, which is like if I say absolute no early on and the company does well later on, like I'll be out, right? So you kind of want to still have some optionality if the company does take off at some point.
Yeah.
I have a
And
question.
that was the last thought. Look, it's super annoying to get a bunch of no's. That's part of any sales process when you sell prospects, like the most people say no. I wouldn't attach too much of sort of emotional value to any of this. People are like we don't know. Like we do the best we can, but sometimes a lot of times I get stuff, and if I really, really wanted to understand the business, if it's like a vertical SaaS thing, like I don't know enough about construction, and like I don't have the time to spend like 25 hours doing like deep industry research in construction, so I can validate everything that you're telling me. I'm gonna say no, but largely because I don't have the time, doesn't mean that you're not building a great construction vertical SaaS business. Like I just don't know. And the fact that I'm at a good firm and I said no doesn't mean you have a terrible business. It's just, so detaching sort of like emotional, emotion from getting those, I think is important. In
Yeah,
some ways, it's a game.
depersonalizing it, it's just part of the business.
Yeah.
Just to like go through the hundreds of thousands of pitch decks and
Yeah.
making split decisions. But as a founder, that like is deeply painful. So that's why I really recommend like thinking of this as enterprise sales. If like you're going through a slew of people and you're getting, data and feedback, and like you're distilling the signal from the noise as you have more of these conversations. So you're able to kind of, as a founder, like decide too, like who's worth your time, right? Like, and an investor ends up stringing you along for like 6 different meetings and you're still not getting any, closer to a decision, like that's also, you're empowered to kind of cut your loss at that point and really, focus on who are going to be the winners of your round. So I know we're over, but I want to kind of share with folks that, we at SVB are still here as a resource. We're back in the market and, working with us as clients, you're able to access our Founder Success Toolkit, which is, accessing the fundraising support materials like this, as well as one-on-one pitch support. We also are a team of ex-founders, operators, and investors who've been in the trenches and like know the chaos theory of startups quite deeply. So feel free to stay in touch, and thank you so much, Matt, for your time and deep dives. Yeah.
That's great. But you guys are doing exactly the right thing, right? Just like be like attend this, something like this, and just be a lot of conversation. So what's occasionally a bit frustrating. I hope that doesn't come across as just entitled or whatever. But there's like so much content. There's great seminars like this, and like you guys are good. Problem is like all the people that should be in this room and are not, and that's the painful stuff. It's like people like show up and they're like, no idea. And information is right here. It's available. It's on blog posts. It's on tweets. It's in great seminars like this. It's I'm vague, but this is great.
So what that means, you are well ahead of the curve.
Yeah, 100%.
Yeah.
100%.
Great. Well, thank you so much, guys, for joining us.
Yeah.